Tuesday, July 7, 2026. Today we're diving deep into India's economic story, the FDI numbers that look great on the surface but hide something troubling underneath, a currency under siege, an IT sector in the middle of a massive reckoning, and a quiet agricultural revolution that nobody's talking about enough. Let's get into it. First up, India's foreign direct investment numbers, and here's the headline that should stop you mid-coffee. India just recorded its highest ever gross FDI inflow. $94.5 billion in a single financial year. That's a record. That's extraordinary. And yet, net FDI, the money that actually stays in the country after outflows are accounted for, has collapsed from $28 billion to just $1 billion in 2 years. Think about it this way. Imagine your salary doubled, but your rent, your subscriptions, your loan repayments, and your lifestyle costs tripled. Your gross income looks incredible on paper. Your actual financial health is quietly deteriorating. That's exactly what's happening with India's FDI picture. Foreign investors, particularly private equity and venture capital firms, have been exiting their positions after earning strong returns. They came in years ago, they made their money, and now they're taking it home. Meanwhile, profit repatriation by multinationals operating in India continues to rise. So the inflows are real, but so are the outflows, and the gap is closing in the wrong direction. Here's where it gets interesting. This isn't necessarily a crisis of confidence. Global investors clearly believe in India, they keep putting money in. But there's a difference between investors betting on India and investors building India. Short-term capital that cycles in and out doesn't build factories, doesn't create durable employment, doesn't anchor supply chains. The quality of the investment matters as much as the quantity. And this is the part nobody talks about. India's policy focus has been almost entirely on attracting gross inflows, cutting red tape, offering PLI incentives, marketing the India growth story globally. But the infrastructure to retain capital, whether that's deeper exit mechanisms for long-term investors, reinvestment incentives, or structural reforms that make India stickier, hasn't kept pace. The revolving door is spinning faster, and the net number is the proof. Next, the rupee, and the currency that's caught between two worlds. The Indian rupee has been under pressure, and the Reserve Bank of India has been working hard to hold the line. The RBI has been selling dollars through state-run banks to keep the rupee in a tight band around the 84.80 to 95.00 zone. And here's what makes this uncomfortable. Even with that intervention, even with lower crude oil prices providing a tailwind, the rupee is still struggling. A currency trader quoted by Reuters put it bluntly. The fact that the rupee remains under pressure despite RBI support and lower oil prices tells you the underlying dollar demand is genuinely strong. That's not a temporary blip. That's structural. An economist at ANZ Banking Group made an important distinction this week. India's domestic macroeconomics are solid. Growth is there, inflation is manageable, the banking sector is healthy. But the rupee's problem, he argues, is more global than local. Tight financial conditions globally mean capital is gravitating towards safe havens and, frankly, toward the giant gravity well of AI-linked US tech stocks. India isn't losing because it's weak. It's losing in a global competition for capital flows. Think about it this way. You're a strong runner, but you're racing into a headwind that everyone else is also running into. Your form is fine. The wind is just unfair. That's the rupee right now. The softer-than-expected U.S. jobs report last week gave a brief pause to dollar strength. But traders don't expect that relief to last. Corporate dollar demand will likely resume. The RBI knows this. And the real question isn't whether they can defend a specific level, it's how long and at what cost to foreign exchange reserves they want to fight a global tide. Now this one is interesting, India's IT sector, and a valuation reset that has been years in the making. Cast your mind back to the post-COVID boom. TCS, Infosys, Wipro were trading at price-to-earnings multiples of 30, 35, even 40 times earnings. There was a moment where Indian IT looked like it could rival Silicon Valley darlings in terms of investor enthusiasm. That era is over. The Nifty IT index has corrected roughly 30% over the past year. TCS and Infosys are now trading at around 14 to 15 times trailing earnings. HCL Technologies sits slightly higher at about 18 times. These are not distressed companies. They're still profitable, still cash generative, still global leaders in their field. But the premium is gone. Here's why this matters beyond the stock charts. The central question investors are grappling with is whether AI disruption is a tailwind or a headwind for Indian IT. For years, the standard answer was tailwind. India would service the AI transition, helping global companies implement, integrate, and maintain new systems. But a growing school of thought says the opposite. If AI automates the very tasks that Indian IT firms charge for, code writing, testing, documentation, help desk support, then the business model faces existential pressure, not just margin pressure. TCS reports its Q1 FY27 earnings on July 9, 2 days from now. That report will be the first major data point on whether the fears are justified or overstated. Revenue guidance, deal wins, and commentary on AI's impact on headcount will be watched incredibly closely. Not just by equity investors, but by policymakers, because Indian IT employs millions of people. And this is the part nobody talks about. The valuation compression isn't just about earnings doubt. It's also about talent repricing. The wage inflation that swept through Indian IT in 2021 and 2022 is now a structural cost burden at a time when growth is slowing and clients are asking for more efficiency, not more bodies. The sector is in a genuine identity transition. The TCS numbers on Wednesday will tell us how gracefully that transition is being managed. Alright, moving on to something that sits well outside the trading screens but has enormous long-term significance, India's agricultural biologicals market, and why it might be one of the most underappreciated investment themes in the country right now. Here's the setup. India's agricultural exports exceed $50 billion a year. Fruits, vegetables, spices, rice, tea, coffee, processed foods, India feeds a significant portion of the world. But here's the problem. Global markets are tightening regulations on pesticide residues. European buyers, in particular, are enforcing stricter sustainability standards. And that creates an enormous commercial opportunity for what are called agricultural biologicals. Think biopesticides, biofertilizers, natural soil enhancers, products that can replace or reduce synthetic chemicals without sacrificing yield. A white paper published this week by the Koch Foundation lays out the investment thesis clearly. Manufacturing, innovation, digital agriculture integration, and export-driven demand are the 4 pillars. And the addressable market is genuinely multi-billion-dollar at scale. Think about it this way. The global organic food market spent decades as a niche. Then consumer preferences shifted, regulatory pressure built, and suddenly it was a mainstream competitive requirement, not a premium add-on. Agricultural biologicals in India are at that inflection point right now. What makes this particularly compelling is the digital layer. The white paper notes that the future market leaders in this space probably won't just be product manufacturers. They'll be integrated solution providers, combining biological products with AI-based advisory systems, remote sensing, precision agriculture tools, farm decision support platforms. A farmer in Punjab doesn't just need a biopesticide. He needs to know when to apply it, and how to document that application for export certification purposes. And this is the part nobody talks about. India's small and fragmented farm holdings, which are often cited as a structural weakness, could actually become an advantage here. Biologicals are, in many ways, better suited to smaller, more varied plots than the heavy chemical regimes designed for large monoculture operations. The challenge is distribution and farmer education, and that's exactly where the digital platforms come in. If even a fraction of India's $50 billion export agriculture shifts towards certified residue-free production, the biologicals market follows. Investors who are looking at India's long game should be paying very close attention. Several of today's stories are, at their core, about the same underlying tension. India's fundamentals are genuinely strong: record gross FDI, a resilient banking sector, growing exports, a manufacturing revival underway. But the country is navigating a world where capital is fickle, global headwinds are structural, and the old playbooks are being rewritten faster than policy can respond. The IT sector's identity crisis and the FDI retention problem are two expressions of the same challenge: attracting and keeping value in an era of constant disruption. The country that solves the retention problem, of capital, of talent, of investor confidence, wins the next decade. Tomorrow on Neel's Daily, Geopolitics and Power. This is Neel's Daily. See you tomorrow.